Welcome to The Explainer. Today, we're digging into a question that's on a lot of people's minds, whether you're looking to buy a home or just watching the economy. Okay, so let's get right into it. We keep hearing that inflation is getting better, that it's cooling off, so common sense would tell you that mortgage rates should be coming down too, right? But they're not. They're staying stubbornly high. So what in the world is going on? To figure this out, we're going to walk through it step by step. We'll start with the data that seems to contradict itself, then talk about the Fed's role in all this, or lack thereof. We'll uncover who's really setting the rates, look at all the other pressures in the economy, and finally, we'll check out what the experts see on the horizon. All right, first up, let's look at the data, because this is where all the confusion really starts. The numbers just don't seem to add up.
And here is the disconnect in plain sight. We got news that core PCE inflation, which is the number the Federal Reserve watches most closely, actually went down. That is fantastic news. It should mean borrowing gets cheaper. But what happened instead? Mortgage rates actually went up a little bit. It makes no sense, right?
And just to give you some context here, look at this journey. We've come a long way down from the peak back in 2022 when inflation was screaming hot at over 5.5%. So even though we saw this tiny recent uptick, the overall trend is clearly downward. And that's exactly what makes these high mortgage rates so puzzling. So naturally, when things get confusing like this, a lot of people look straight to one place, the Federal Reserve. The assumption is they're in control. But are they really the ones pulling the strings when it comes to your mortgage? Well, it's a little more complicated. You know, this is probably one of the biggest misconceptions in finance. It's not like the Fed has a big red button on the wall that says 30-year mortgage rate. They just don't. Their decisions definitely make waves, but their actual control is much more hands-off than you might think. So what the Fed does control is this thing called the Fed funds rate. The easiest way to think about it is it's the interest rate banks charge each other for overnight loans. It's the foundation for short-term stuff like credit cards and car loans. But a 30-year mortgage? That's a whole different animal, and it plays in a different park. And hey, you don't have to take my word for it. We have a perfect real-world example. At the end of 2024, the Fed cut its main rate by a full point. You'd think mortgage rates would have followed, right? Nope, they went the other way. They actually went up because other, more powerful forces were at play. Okay, so if the Fed isn't directly calling the shots, then who is? Well, to find the answer, you've got to follow the money, and that trail leads straight to investors and the global bond market.
This right here, this is the number to watch, the 10-year Treasury note. It is the single most important indicator for where mortgage rates are going. It's seen as a super safe long-term bet, so basically sets the floor for almost all other long-term loans, including mortgages.
And then there's this other crucial piece of the puzzle, mortgage-backed securities. Now, it sounds complicated, but the idea is pretty simple. Most home loans get bundled together with thousands of others and sold off to big investors. The interest rate that you end up paying is basically set by the demand for these bundles. So you can see how it's all connected, right? It's like a chain reaction. Investors get worried about something down the road, maybe future inflation or government spending, so they demand a higher return for their money. That pushes up the yield on the 10-year Treasury, and like clockwork, mortgage rates follow right along.
But wait, there's more. It's not just about what investors are thinking long-term. There are a bunch of other forces pulling on rates right now, creating this giant economic tug-of-war.
Let's throw another log on the fire, shall we? Tariffs. You might not think they connect to your mortgage, but oh, they do. According to researchers, tariffs add about $1,700 to the average American family's annual expenses, and that money has to come from somewhere. And where it goes is right into our old friend inflation. Economists figure that these tariffs are responsible for about 0.4 of a percentage point of that core inflation number. And, as we've already seen, anything that keeps inflation higher for longer is going to keep those bond investors demanding higher rates. Okay, so it's not all bad news. Amidst all this pressure, there is a little silver lining. It's something called the 30-10 spread. Basically, it's the gap between that 10-year Treasury yield and the mortgage rate you actually pay. For a while, that gap was unusually wide. But now, it's starting to narrow and get back to normal, which is a genuinely positive sign for homebuyers. All right, so we've got cooling inflation, we've got nervous investors, we've got tariffs and spreads, we've got this whole economic mess. So where does this leave us? What's going to happen next? Let's take a quick peek at what the experts are thinking. Well, as you can see, even the pros are a little divided. Fannie Mae is on the optimistic side, predicting rates could actually dip below 6%. But then you have the Mortgage Bankers Association being a bit more cautious, thinking they'll hover around 6.4%. And that difference just shows how much uncertainty there still is in the market. And that really brings us to the big final question, doesn't it? It's all about this economic tug of war. On one side, you have cooling inflation pulling with all its might to bring rates down. But on the other side, you have investor anxiety and all these other global pressures pulling just as hard to keep them up. It's a huge battle with real consequences for all of us, leaving everyone to wonder, which side is going to win?